The types of errors. That is AFM revision. Some one. That type of errors. So the first one you say that the first type is called error omission. Error omission. And I hope that you have written that. So error omission, we say that this is where there is a failure to record an item. Where you fail to record an item is called error omission. For example, we normally have invoices. So when you make sales, when you're doing accounting and the sale that has been made, you normally post the invoice. What will happen is that invoice is like a bill. So the person that you have given the service will bill you, or you bill. So let's say that you bill, you have given the service, so you bill that client. And so when you bill, you'll be able to raise invoice. You're saying raising invoice. That is a bill, then you send to the client. So invoice is a bill that shows that you need to be paid. It's normally from your side, it is receivable. So that is receivable. So when you raise invoice, then you're going to credit receivable, you're going to debit receivable, and credit sales, even before you receive the money. Maybe you make the transaction or you made the sale, you're going to credit with the amount. You're going to have sales receivable or you have debtors account. This is what we call debtors account. So you have this, let's say 10,000, and then you credit this particular account with 10,000. Now, sometimes you can forget to raise the invoice. You can forget to raise the invoice when you make the sale. Now that is an error omission. Because if you don't make the invoice, you're basically understating your sales. When you don't raise the invoice, it means that you will not recognize sales and you don't have receivable. So this is now total omission. Total omission is going to omit both sides. Therefore, this figure will not appear in the trial balance. Trial balance normally have got both the debit side and credit side, right? So if, for example, you're supposed to record sales, should come here as 10,000, and then you record receivable somewhere. That should be on this side 10,000. So the balance here should be the same 10, right? But because you fail to recognize them, there is total omission. Then it means that you omitted both sides. Total omission meaning that you omitted here, right? So if you're doing manual, then you can actually omit on one side, but you post on one side. If you're doing on Excel, you can record sales where you recognize one side, but you can omit one side. That is partial omission. Partial omission, you'll be able to recognize that trial balance is not balancing because one side has one figure when the other side is having. So partial omission is okay. That one you will not notice. But total omission means that you omitted both sides, right? Now, that's how the transactions happen. Now, with the system you cannot omit one side because system will demand when you make sales, the system will require you, as you credit this, they will require you to debit somewhere. That is what we call the principles of double entry. For every credit, there must be a debit. So that means that the system itakata kusonga. You will not. Unless now you go and pick a wrong account, and that is what we are referring to, error of original entry, where you post the wrong account. So you can post, you've not omitted, you posted deal, but you post on wrong account. Now that makes it a different type of error. It's not omission now, but error of original entry. You entered in the wrong account or wrong account. That is what we are referring. So these are what we call accounts. So instead of now crediting sales, you end up crediting a different item, which is not sales, right? Yeah. So those are how the errors happen. The second type of error is called error of omission. So this one we have said that this one affects the total omission, it affects the trial balance, right? Yeah. No, it will not affect the trial balance. You will not realize. Partial, if it is on that one, you'll notice the trial balance. This one, if it is total omission, you'll not notice because both sides are left out. So we are saying that error of commission is the mishandling of an item by putting it in the wrong place. Mishandling of the item by putting it in the wrong place. Mishandling of an item by putting it in the wrong place. So, for example, you can be having sub-accounts. So I told you, for example, listening, when you are using system, there are normally major accounts, for example, expenses. Now, under expenses, we also have sales. They are already there. You can create in the system expenses and sales. But now here you have sub-accounts. So these are the major accounts, main accounts. Then here we have sub-accounts. So it can be transport. It can be maybe stationaries and printing. It can be office tea. It can be some office tea. Sometimes they don't want to mention that it's tea. They call it office general expenses or consumable. So at the end of the day, what matters is that it's an expense. It's going to be expensed. So that's how. As long as the account the sub account makes sense, is relevant. Whether they call it consumable or they call it office expenses, or but they should not call it general expense or okay, well, there's nothing like general expense. We need to give us an idea or a hint to know which kind of general expense it is. Is it an office or which one? So in commission, you posted the correct amount in the expense. You posted in the main account, which is correct, but now the sub account is wrong. Instead of transport, you posted here. You've committed an error. Instead of posting here, you post here, stationaries. Printing and stationaries. Instead of posting here. So that is what we mean. Mishandling an item by putting it in the wrong place. So the amount you enter is correct, in that case, right? And you even put it in the right class or general account, so that is the main one, but use the incorrect sub account. You now use the incorrect sub account. So you can say that, for example, in fact, you don't need to write, just need to understand. For example, when you receive payment on an invoice, but not the receipt against a different customer's invoice. So it means that you receive the payment, but then you noted, you put the note on against a different customer. Both of them are sales. Both of them are reducing receivable. See, I have two clients. So if I have two clients, I can actually raise the invoice to bill them. When they make the payment, instead of now going to reduce customer A, I reduce customer B. That means that in the general account, which is the main one, they are all receivables. I will reduce the receivable. The correct amount has been posted. But from sub account, I've reduced different client instead of client, the right client. So that means that that's how the error can be made. So again, for invoice, you can receive the invoice. That is a bill. If you receive the invoice, it's a bill. If you make the invoice, you're the one who issued it. It is a claim. So to you, it is receivable because you are claiming from that person. But when you receive it, it means that somebody else raised and gave you. So it is a bill you should pay. You need to recognize it as payable. So for receipt of invoice, it is payable. For issuance of invoice, it is receivable. So, yeah. Now, the next type of error that I want us to look at is now error of transposition. Error of transposition. Error of transposition. Error of transposition. So how are you guys? Feel welcome. We are just revising some questions on financial accounting, right? We are looking at financial accounting 1, and I've just noticed that there are a lot of theory questions that come in that particular paper for foundation level and intermediate. The theory questions are normally 20 to 26% in every sitting. So I'm trying to tell my students that when you're given a paper, that is financial accounting, and the paper will have around 25 or 24 marks, which is totally theory. I'm advising my students that please try to make sure that you answer the theory questions, because the first mark is normally 50. First mark is normally 50%. So imagine if you get 24% from theory. Hizo hesabu yote unafanya, the old calculations that you'll be now calculating or doing, you'll be only working towards getting 26%. And normally, this theory question is normally on question number 5, where they're asking you simple questions. Like now, we are revising the paper, 𝗲 was sitting, just show me the sitting again, sorry, I lost it. We're looking at the first paper where they're asking you to give the types of errors that cannot be realized. Financial accounting 1 and 2, both of them are relevant. As long as you're doing financial accounting, they are relevant because errors are the same. Error is error. So they are relevant. Any question? Somebody wanted to ask a question? Now I'm trying to look at this question. This is sitting for they're just the same. It's only that ingine wanaweza set ikiwa ngumu kidogo, but the content is the same, because if it is error, error is error. Error is just error, so you need to understand. I'm looking at the setting that we are looking at here. This is December 2021, question number 5. December 2021, question number 5. December 2021, question number 5. Okay, so error of transposition. So we are saying that this is where we say that it can be caused by extending the numbers, where you have, instead of writing 56, you write 65. That is one error. So you can say that that this one is caused by, you can write and say that this is caused by recording the incorrect amount by reversing the numbers. It involves recording the incorrect amount by reversing the numbers. Recording of the incorrect amount by reversing the numbers. This error is normally caused by recording the correct amount by reversing the numbers, such that instead of writing 56, you write 65. That is what we call the error of transposition. So in accounting, that do happen. In accounting, that happens. It happens in accounting, you put the wrong error. The next one is called compensating error. So again, transposition error you will not realize. If you're using a system, you will not realize that this one has happened through trial balance. Why? Because the system will request you, whenever you are having the figure, for example, you post sales, you'll credit sales with maybe 56,000, which actually should have been 65,000, but you posted at 56,000. The system will automatically request you for the contra entry account. Just mention the contra entry and it will link them automatically. So that means that here you made an error, transposition, and also when you come here, maybe on receivable, you are going to debit with the same amount, 56,000. 56,000. That is if you have the system that picks automatically. If you have the system that does not pick automatically, you have to punch in, then you realize that it is an error because it will not go through. It will not go through. And if it is manual, then the trial balance will not balance. If it is manual, the trial balance will not balance because you're going to post here manually 65. You're going to post 65, and so this figure is different from this. The trial balance will not balance. It is manual. If it is automatic, it picks automatically, then there will be two wrong figures. It will be two wrong figures. So again, that is something that you need to note. Now, the next one is called error of compensating error. Compensating error. You can say this occurs where there are two errors. It occurs where there are two errors that took place at the same time. There are two errors that took place at the same time. This one I've actually experienced this. It occurs where there are two errors that take place at the same time. From the word compensating, to compensate. Now, let's take an example. Let's take an example. And this one will not be realized by the trial balance. Let's take an example. When you are making, maybe you purchase some item. Let's say that you purchased land. You purchase land, and at the same time you purchase motor vehicle. Then what error are you making? You end up posting, maybe the opening balance for motor vehicle was 600,000, and the land was land was 1.6, and maybe motor vehicle was 500,000. When you purchase additional motor vehicle, instead of posting here motor vehicle, you end up posting here. You added it on this account. So you posted where? Here, 1 million. So that's an error already. In the same period, you also purchase another item, which is now land, worth 3 million. You posted here 3 million. So you see, they are all errors, but they're compensating each other. One is overstated, another one is understated. One is overstated, another one is understated. Because you can see, land is now understated because according to the report, land is recorded as 1 million, when actually it should be 3. So it is understated by -2. Well, motor vehicle has been overstated by +2. Because it should be 1 million, but you posted as 3 million. So they cancel each other. This kind of error you not realize on the trial balance because the contra entry for both of them, as you debit this, you are crediting cash book. You go to cash book and credit cash book against land, and again cash book against land. At the end of the day, the trial balance will not balance, but there are errors that exist. They compensate each other. Therefore, we call it compensating error. That one is an error that trial balance will not balance. Will not realize. It will not affect the trial balance. The next error is now number 5. It's called error of duplication. Error of duplication. So you posted twice. I want you to write that. I want to say that it occurs when you enter the same item of income or expense more than twice. You decided to post, but you post twice without knowing. You posted revenue twice without knowing. You posted revenue twice without knowing. You post revenues twice without knowing. So, without knowing, for example, such an error can happen when more than one person has access to the accounting system. You are 2 people who can post sales. So maybe Kevin Mwangi has posted the sales. When you come in the afternoon, you also post the sales. So your team, your colleague posted in the morning, When you come in the afternoon, you also end up posting. Then that one is now what we call it duplication error. The next one is error of principle. Error of principle. So this is where you record an item that does not comport with the general accounting principle. Does not conform with the general accounting principle. You post an item that does not conform with the general accounting principles. General accepted accounting principle. With the general accepted accounting principle. So you, for example, when you're posting an entry in the wrong account, when you're posting an entry in the wrong account, let's take example. When you make installment payment for taxes, what happens? Installment payments for taxes is like a receivable because you need to make installment before the end of the year. That is why it's called installment. For tax planning, what happens that let's say that in 2022 we made a profit of 200,000. This is the amount that was taxed. So what happens that now you estimate and say that I think next year, or you pay tax. Let's say that you pay tax. Tax paid was 200,000. Tax paid. So it is required that you now plan for tax that you pay next year. Now you know what you paid this year. You plan for what you're going to pay next year, or let's say 2023. So how do I know? You do tax installment plan. You take 110% of the amount here. So you take 110% of this one. So that gives you how much? 220. So you say that come last year you got 200,000, then most likely this year I'll pay 220. That is how you know the amount that you pay for tax plan. Now this amount, we need now to divide it into four equal installments. So divide this by 4. So that will be 55,000. So 55,000 divided by 4. So January to March, you need to pay that amount. So what you do, by April 25th, 25th or 22nd, 25th, you need to pay for the first quarter. This is the first quarter. So the amount you pay the following month, April. So you pay this. Again, for April, May, June, you pay July. July. This one here. I need to confirm the exact date. Then here. 55,000, yes, 55,000. You are going to pay 55,000. Now, these are what we call installments. How do you record them? Because at that time, you are paying in April part of the taxes that you pay at the end of the year. It is not an expense. Tax is not an expense. So what you need to do, you need to have installment account, which is a receivable. Because in case you pay excess, KRA can actually claim it back. So you have it as a receivable installment account. So the mother account, which you call general account, is receivable. Then under receivable, you have installment account. So as you debit that, you credit back. Right? So double entry goes through credit. So you have bank here. You credit and debit receivable. So what we are saying, where you have treated this as an expense, instead of having it as a receivable, you will have it under expense. Under expense, you create installment tax account. The TB will still balance. But are you following the accounting principle? No, because this amount is not an expense. It's the amount that you are waiting, KRA will pay you back. ni kama umelipa in advance. Lakini in case you realize that you don't have any tax to pay, they should pay you back sometimes. So it should be under receivable and not an expense. That is accounting principle. So when we are posting and differing in terms of the accounting principle, that kind of error is called principle or error of principle. Error of principle. So we are saying that does not conform with general accounting, general accepted accounting principle. Usually it happens when an entry is made in the wrong account. The amount is correct, but is simply entered in the wrong place. You can add there. The amount is correct, but entered in the wrong place. The amount is correct, but entered in the wrong place. Error of entry reversal. Error of entry reversal. So it is the result of treating an expense as an item of income or vice versa. You can write.
Is this there is one class of account?
That was the class of account.
No.
So that was the class of account, a sub-class of account, which is the same. That one we said that it is in the correct general account, but in the subclass. But this one, the main plant.
We define error of commission, putting it in the wrong place.
Wrong sub-account. You add something like sub-account statement.
Mishandling of the item by putting it in
the wrong place. Proceed.
The principle to is correct amount entered in the wrong place.
Wrong place. Which wrong place? Well, that was error. Which type of error was it? Which type of error was it? Commission. Principle. Principle, we are saying that you are treating it in a different way. I've given an example where you have payable. Both of them are debit. And now you don't know whether it should be a debit or it should be an expense or a receivable. Both of them are debit. Principle. Right? I'll give you an example of installment. When you're making installment, you create the debit, receivable, you credit bank. Sasa, you can still balance, but now instead of putting as a receivable, you decided to put it as an expense. But if you go to account your credit, debit, here I change. When there is an increase in expense or receivable, both of them are debited. But now you don't know whether it should be here or here. That is the one I'm referring to. Now, the one that we are referring to is the reversal. You put it vice versa. For example,
when I was talking about its commission.
Commission.
So
commission, we said that the amount is correct. You entered in the correct general account, but wrong sub-account. And I gave an example. Listen, sub-account, I gave an example. So this one is different. We're not talking about sub-account here, like that one. We're talking about the principle on how it should have been treated. In sub-account, we are saying that you have it, have a general account in tofauti. Receivable and expense, those are all general accounts, but it is a wrong general account. In sub-account, we have expense, which is general. But now you're putting it under printing and stationaries. It is still expense, which is general is okay. But the sub-account is printing and stationery, where we work about consumer. So the mother account, which is expense, is fine. And like this one, you didn't know how to post it, where it should be treated. This one, the question was, how should it be treated in accounting terms? You're wondering now, instrument now paid the government already. Should I have it as an expense? Or you make it come a receivable because I'm expecting to receive. So you start reasoning. So you need to understand the basis under which you're making the entry. You're paying the government in advance. Any payment you make in advance is receivable. So it is accounting principle. So just the same. Let me give you an example. When you are having rent arrears, somebody can say that, okay, we can have it as paid. That is a accrual basis. So you're not paid, but you call it as paid, as rent. So rent paid. But somebody can say, okay, how should we have it in account? Maybe you should only recognize it when the payment is actually made. Wakati nimelipa ndio sasa nirecord. Kama sijalipa, isahau. So you come and now argue on the principal's account. You say that which principle now guides you there? The principle that guides you is the accrual basis and cash basis. But you need to decide the principle that you're using, then you go as per the provision of that principle. So that is different from this. This one, you have made a sale. But now you post the reverse. It is a sale, but instead of posting for sales, we post for expense. This one, entry, reversal. You put it the reverse, the opposite. So it is called an entry reversal. It's the result of treating an expense as an item of income. Where we make sales, lakini ukienda kurecord, una record kama expenses. You put the reverse, the opposite. When you make an expense in your books, you record all expenses as incomes. So out of this, we talked about complete reversal error. This one, if you post it completely, meaning that it is wrong, you recognize it as sales, but then also you have also posted in the contract count. It's an error. Let's say that you made a sale of. So when you make a sale of, let's say 10,000, right? What you're supposed to do is to create sales account and debit bank. Here, 10,000. But what did you do? Instead of posting sales, you came and debited expense with that amount. Right? You debited expense with that amount. Or even if you credit expense, let's say that we could have a credit expense with that amount, 10,000. And you do what? Debit bank here. It is an error. It's still an error. But because there is double entry, it will balance. So this is called complete reversal. If you've done only on one side, sales only, you've done only sales, ndio iko na error. Hii ingine hauja post, it will be known. Kama ni manual system, unaweza enda kwa sales account, you post sales, and then you forget to post bank. Because when you make sales, pesa inaenda kwa bank. So for manual systems, you can be able to post here, and you forget bank. That is now partial. But for full, you have to do the double entry. The system allows. When you have done the double entry, whether it is an error, as long as the system remembers, or the system will realize that there is a double entry, the trial balance will balance, because kuna 10 huku, kuna 10 huku. That is now complete reversal. So I want to look at specific errors that cannot be revealed by trial balance. Errors that will not be revealed by trial balance. The first one is error of omission, total omission. Error of omission. So error is not revealed by trial balance. You are told to give that one. That was a question.
Yes.
Or in other words, they can say errors that will not affect the trial balance. Errors that will not. Osman, long time, Bana.
Long time to Mr. Dennis.
Yes. We are trying to look at past paper here. We're doing revision on some of the past paper questions. Now, the next one. We are now looking at errors that do not affect the trial balance. So the first one, meaning when we say that does not affect trial balance, it means that trial balance will not be affected and therefore you'll not be able to recognize or notice it through trial balance. And it does not have any effect. The first one is called error of omission. We will explain what it means. The next one is error of commission. When you commit error, you made the wrong entry, but it is complete. It is wrong, but wrong in both accounts. The debit side is wrong, the credit side is wrong with the same amount. That is commission. That will not be realized by the trial balance. The next one is error of principle. Error of principle. And I'll give you an example. The trial balance will not realize that. Compensating error. So I gave an example with that, right? Compensating error. The trial balance will not realize that. Complete reversal. This one here. Complete reversal. Complete reversal. The trial balance will not be able to realize that. Then the last one, duplication error. Duplication error. Transposition error. Duplication error. So we say that complete reversal is where the account that is supposed to be debited is credited, and the one that is supposed to be credited is debited, right? For example, now we say you end up crediting expense account instead of debiting it. You made the sale instead of either you post in the wrong account, like in this case, instead of posting the sales account, you ended up posting in expense account. That one will not be realized. Also, where you made the sales, instead of crediting the sales, instead of crediting the sales, you debited the sales. It will not be realized because the contract entry will be the bank, which will now be created. So the trial balance or the system will still balance both sides. You posted the reverse of what you're supposed to do. You credited expense instead of debiting expense. You debited sales instead of crediting sales. That is complete reversal. Complete reversal. Now, I want us now to look at the principles or ethical standards in accounting. The ethical standards, stroke codes of ethics in accounting. Ethical standards. Codes of ethics in accounting. So the first one, we need to understand that as accountants, you're expected to adhere to some codes of ethics as professional. Just like doctors, we can't allow doctors to misbehave. Engineers should also not misbehave, because if they misbehave, they can actually build houses that can easily fall down. So we need to have the guidelines, the basic guidelines. When you talk about codes of ethics, these are the acceptable behaviors or standards in a certain community or in a certain within a certain setup or group of people, the way they are expected to behave. Now, auditors or accountants are also expected to behave in a certain way. Number one, we need to ensure integrity and independence. Let me just write that separately. Independence integrity, and independency. Those ones you are written. Okay. So that means that integrity is about being honest. Being honest in whatever you do. Because as an accountant, you can realize that you're going to be exposed to a lot of information. And the way you are reporting them, the way you are advising the management as far as the financials are concerned, you need to be very honest. Integrity, independence, it means that you need to be somebody who can actually make an independent decision. You're making decisions without being biased or influenced by anybody. Make a good decision without being biased. And of course, here we have types of independence. We have independence in appearance. And we have independence in mind. Independence in appearance and independence in mind. So independence in mind is having a state of mind that is not influenced. Independence in appearance is about behavior, the way you relate to people, the way you behave. So we are saying that as an auditor, because after CPA you become an auditor, as an auditor you need to behave in a way that does not undermine the profession, in a way that can actually uplift the name of the profession. And then independent in mind, the way you have judgment, you need to have a stable mind that is able to make a judgment that is independent without being influenced. The next one is objectivity. Look at things in a broader way. Being focused. Somebody saying that I need you to be objective. You need to be somebody who thinks outside the box, who is looking at things in a broader way. You try to look at the bad part of it and the positive part of it. So that means that as you make your decision, you need to know that that decision can actually have implication. And what will be the implication? Then we have number 4, which is about confidentiality. Confidentiality, basically keeping class information and the organization's information confidential. Then we have competency. Competency, to be competent is to know what is being done, to have technical know-how, being able to do what is expected. As an accountant, you cannot make errors. You need to be able to know what is expected and how it should be done so that you don't lie. If you don't know what needs